Welcome to another episode of the BlueFort Blueprint. It's been a while, but we're back. We're going to talk about the current events and what's happening in the last few weeks. I'm joined, of course, by Sayyam and Viraj again. So, guys, I think in the last 1 week, I've been getting a lot of messages, a lot of bombardment, pun intended, because it's about the Middle Eastern war, right? And how that is impacting the equity markets. And I'll begin with a funny story. Just this Sunday, right, when Israel had retaliated with this missile attack that Iran had started with, right? I got a call from a client who said that, oh my God, did you hear about what happened? Did you hear about the war and how is it going to impact the equity markets and what should we do with the portfolio? And I told him that, look, I have no idea what you're talking about. I asked him stupidly because I had just woken up. I'd asked him, what war are you talking about? Are you talking about the Russian-Ukraine war? And he just went silent. And he was just like, you're in the equity markets. You don't even know what's going on. I'm like, sir, it's a Sunday morning and I don't feel the need to be updated with every single second on what's happening. And he was, of course, talking about, the Israel attack on Iran. And that's when it clicked to me that a lot of people are very concerned with what's going on. We may not think this way, that current events affect the portfolio in such a way. But a lot of people are wired to believe that we must have an answer to what's going on. So I thought today we'll talk a little bit about that, how to think and how to unravel the current situation, the current tensions in the Middle East and what impact it has on the Indian stock market or the Indian economy.
I think the answer to this is just going back and seeing what's happened in history. Counterintuitively, you would think that wars destroy countries, destroy the economies. But typically what's happened is that in the build-up to the war, when the likelihood of war is increasing, the markets tend to correct then. You see sharp sell-offs. We've seen that once the war actually starts, the market recovers pretty quickly. And very interesting statistic is that during the Second World War, 1939 to 1945, Dow Jones in that entire period was actually up 50%. Right. So even in a war where the US themselves were involved, the whole world was ravaged. In that, the stock market actually went upwards.
So in fact, there's an interesting research by the Swiss Finance Institute, right? What the research tells us, it's something the term is called the war puzzle, right? It basically tells us how does stock prices are affected by the wars, right? One interesting conclusion that the group of researchers came up with was that the stock prices in the anticipation of a war, or let's say pre-war, when there is a strong likelihood of a war, they tend to correct.
Correct.
But once the war has already happened, or let's say the war has already started, so during the war, they tend to kind of go up, right? It brings it down to the simple fact of how markets behave in every given situation is uncertainty and certainty.
Right.
During the likelihood, people are not very sure as to how big that war could be. It could be the Russia-Ukraine or let's say the Israel-Hamas war.
Yeah.
It could be a very big war which could result in a World War III, or
Correct.
it is a simple conflict between two countries, right?
Right.
Also, the primary market, as let's talk about the Indian markets or the US stock markets, for example, are they going to be really affected by that or not, right? Is the question. So once that certainty comes in, that okay, this particular war is between Russia and Ukraine, Israel and Hamas, and of course there are certain political influenced countries that are funding the war or kind of making the most out of it. If India is averse by that, then our economy is not going to correct and our stock prices are going to come back to pre-war levels.
I remember there was a lot of panic when Russia had
Correct.
invaded Ukraine and the stock prices had corrected just a little bit when we had heard that news. And then nothing really happened. I remember, even as the war got worse, Indian markets still were very, very stable. On the contrary, if somebody would have done a little bit of research or a little bit more thinking, it actually turned out quite well for a lot of our industries and a lot of our companies. Why? Because we started getting very cheap oil. India is someone who imports a lot of oil, right? So we started buying cheap oil from Russia. And the fact that we have great relationship with them and the West, right, is something that is a big asset to us, right? And a lot of, which is why the Nifty companies, for example, never corrected, because Reliance Industries, let's take Reliance Industries as an example, which is a very big weightage in Nifty.
Right.
They would have profited massively off of the cheap Russian war, which then they re-exported to a lot of these European countries who were not buying Russian oil, right? So investors actually benefited off of the fact that there was some conflict in some region. So I think that people tend to always think the immediate reaction is that war hai, I want to stop investing. I want to, just sell off my entire portfolio. But the relationship is a little more complex. It does not necessarily work that way always.
In fact, it's more dependent on the country you're talking about. Let's say India, for example. It depends on where we stand. For example, if the Russia-Ukraine war had happened 10 years ago, then I would also be a little bit more concerned, considering we were not that independent back then, considering our market was not that resilient, right?
Yeah.
Right now, if you see in any given metric, Indian markets, and we've spoken about it on our previous podcast also, that Indian market is one of the most resilient markets right now.
Right.
And what we did beautifully during that entire Russia-Ukraine war was that we have told the world that India is not here to bow down to any energy swings or oil swings, right? If we get cheap oil or cheap
Correct.
energy from somewhere, we are going to go for it.
It's not a recent thing that's happened, right? Even this war in the Middle East, so to say, it started in October, 7th October, Hamas attacked Israel.
Correct.
And since then...
Oh, really? It's been 6 months?
It's been 6 months, exactly.
Wow.
So, and since then we look at the market's taken it in its stride, and it's barely reacted negatively at all. The market has continued to hit a new high. So, it's something that's ongoing. Every now and then there will be some news coming in, some retaliation, something or the other. What we have to look at is the core fundamentals. If there is any sort of big news or retaliation, there may be a temporary correction, but if anything, I think that can be seen as an opportunity, because throughout history we've seen across wars that the sell-off that happens after any major news or any event recovers very, very quickly.
As three wealth managers talking here right now, the core importance or core fundamental thing for us to do is to protect our clients' money at any given, whatever situation there is. People tend to forget that we've seen a worse situation where literally industries and people were at their homes 4 years ago. It's not even that long, right? And you see the effect of that as of now on the stock market. Literally 3 years, 4 years, nobody even talks about the COVID fall, right? So, including that, right? Thinking about that, right? Wars will give you an opportunity, is how you tend to take it and, try to strengthen your portfolio rather than being scared out of that.
Yeah, even that point earlier of oil prices, I think it's highly overplayed. In 2020, oil had again dropped down to almost $35-40.
Correct.
It was in the negative for a bit.
It was the futures were in the negative for a bit, I remember. And from 2020 to 2023 almost, I think oil prices went again to $100. Yet this is some of the best time in terms of equity gains that somebody could have made. If somebody tries to draw these simple relationship, war equals to bad for equity, or if high oil equals to bad for India, these things don't hold true. It's a lot more complicated than that. Investing anyway basis any event is just a bad idea. You're setting up yourself up for failure. First of all, it's not controllable, and secondly, you will not be able to accurately predict what's going on because there's too many variables at play, right? So the best thing to do is extend your time horizon a little bit, and instead of thinking about the next 1 month, 2 months, 3 months, you should be investing anyway on the basis of 3 years, 5 years, or even longer.
Simple thing. Whenever you're confused about what's going to happen, when in doubt, zoom out. Just zoom out, look back at the long-term chart, 10-year, 20-year, 30-year chart, and that tells you what the general direction of the market is. Of course, there will be some volatility here and there, but what we want to do is ride the general upward trend and not take advantage of short-term gains or falls.
And we've been through multiple wars where our country was involved, forget somebody else, where even our country was involved.
Right.
And all of those events have proved brilliant buying opportunities.
As a country, if you have to look at it from a stock market point of view, the top 50 companies, the top 100 companies, literally every employee is working their hearts out. Everyone is on the field. Nobody is getting impacted as much from the Israel war or the Ukraine war. So there is absolutely no reason to worry for us, right? In general, people are focused, people are doing their own thing.
Correct.
So our markets are going to be, indifferentiated to the war.
Yeah, at least if not corrected, then insulated or
Correct.
protected
Absolutely.
at best. It seems that Indian market should be quite protected from what's going on. Right.
So then a general question, what's the outlook of view on the market going forward the next 1 year?
So I think I said in the last podcast that everybody seems to have this notion, tie the war and inflation into the fact that the markets are at an all-time high. Everybody seems to have this notion that we are in for a disaster. Okay, that now the recipe is set for something really bad to happen. And again, if you look at data, if you just do a little bit more homework, you will understand that is just not the case. In fact, if you ask me, I do not expect the Indian markets to correct. I don't expect that you will get some amazing buying opportunity, where the markets will crash 20%, 30%. It's just not going to happen because this rally has been backed by fundamentals.
True.
Right? If you see Nifty and the current valuation, it's actually not that expensive compared to where it was historically, right? A simple, research on how the earnings growth of the companies have been. See, in the medium term, Nifty consists of 50 companies, right? And those 50 companies, how they do in terms of the profit they generate, that's how Nifty is going to do. In the last 3 years, they've grown at a CAGR, the profit has grown at a CAGR of 30%.
Right.
So the economic boom is actually converting into corporate profits.
Correct.
So no wonder Nifty is an all-time high. In fact, if Nifty was not at an all-time high, I would be surprised that what the hell is going on.
Correct.
So I'm not saying that there's no overvalued pockets in the market at all, but that's all there is. There are certain pockets that you should avoid.
Isme, you have to think of it from this perspective also. Basically, negativity sells. Today, a news channel will come up and say that, okay, this guy is arrested or this has happened in this and whatever. Indian markets are bound to correct. You will see multiple articles through Mint or Financial Times ki, yaar, we are at overvalued. Or let's say there is a bubble, there is a frost or whatever these new words that are coming, right? It's absolutely, I feel that's absolutely rubbish. The point is, अगर आप 6 महीना 3 महीना देख ही रहे हो तो irrespective don't stay in the market.
Yeah, so I think we can all agree that we should not invest on the basis of events. And the good news is, I think to some extent, the Indian public also understands that. Because if you look at the SIP book, right, of India, if you look at the way the mutual fund industry has grown in India, this means that Indians have a lot of faith in the Indian equity markets, and despite what's going on in the world, people are continuing to pump money in it no matter what. We are less reliant on FIs than we have ever been. It doesn't matter if they pull money away, they change their mind every single day, but we now have a set of investors who fundamentally believe that this is the right place to be. Right now, mutual funds, the industry, in the last 5 years, I think it has doubled in terms of AUM, right? I remember when we started our career,
Right, yeah.
we still had to explain to people what a mutual fund is.
Correct.
Right? Because there was no fundamental trust. Now we don't have to explain to anyone.
That's not a question anymore.
It's not a question anymore, right? So it's gone from, I think it's become 55 lakh crores now from like 23 lakh crores, which
Right.
is absolutely huge. But at the same time, people have started making multiple and many, many mistakes
Correct.
in their mutual fund portfolios, right? There's a lot of portfolios that we see on a daily basis where you feel like, yaar, क्या कर रहे हो भाई तुम, मतलब what the hell, this is not the way to invest. And people have to understand there's a very big distinction between a good mutual fund portfolio and a bad mutual fund portfolio. It's not that mutual fund है तो सही है.
Correct.
ऐसा नहीं है. You can go really, really wrong also. ठीक है?
We've seen that firsthand. We've
Correct.
seen these things.
So let's discuss what are the basic mistakes that people make while investing in mutual funds, because we see, I think we can list it down to like 5-6 mistakes. If you avoid these basic mistakes, then what fund you buy doesn't quite matter. What is your opinion?
One fundamental mistake, I think what comes back to the last point that we just discussed about the war, is the time horizon. People just come in the equity markets because a friend is doing, or let's say because someone has told them to do some investments at any given point of time.
Yeah.
And they be like, चलो ठीक है, ये क्वांट का स्मॉल कैप फंड बढ़िया लग रहा है, इसके रिटर्न 50-60% दिख रहा है, तो मैं डाल देता हूँ, right? Not understanding where the small cap benchmark is today, not understanding whether they have that appetite for their taking a risk of a small cap fund, and also not understanding whether how long do they want to be in, right? People just know कि अच्छा ये करना है, but वो करके तुम्हें ये पूरा रास्ता जाना है आगे और कहाँ पहुँचना है वो किसी को पता ही नहीं है. So
you're saying short-term horizon is one of the issues with...
The mentality has become of quick money, short-term horizon. That's why.
Right. I was reading that almost 70 to 80% of investors hold their mutual fund for less than 2 years.
I'll tell you what, these are the do-it-yourself or DIY investors that they say. Because as I said, no, उसको बस लगता है कि कुछ करना है और फिर कर रहा है, अच्छा ये ठीक नहीं लग रहा है, गलत टाइम पे शायद आ गए होंगे या कुछ और कर गया, तो चलो इसको निकाल दो, कुछ और कर लेंगे.
Correct.
So the average SIP period on all of these platforms like Zerodha and Grow and so on is just 6 months. Which is just ridiculous, right? It's not...
6 months only?
Yeah, the SIP that they run it, and then 6 months baad they're like, okay, I'm not really enjoying this fund, or let me stop this fund, go to another fund. So what Viraj was saying, the lack of planning, the lack of long-term approach, then what leads to the second mistake, major mistake, is over-diversification, where you pick up a couple of funds that you think are good, probably looking at past returns or a friend recommended it. Then after 6 months, you're like, nahi, maza nahi aa raha hai. Let me look at another one. I have personally seen a portfolio with 60 different funds in them.
Wow.
While that is an aberration, it's not abnormal to come across portfolios with 15, 20, 25 funds. right? You're not going to outperform the market if you're holding on to the entire market. You're better off just buying an index fund and save on cost at least.
It's a very, very thin line between duplication and diversification.
Yes.
Now, if I am, for example, I am buying a Mirai Asset Mid Cap Fund, and I'm buying an Edelweiss Mid Cap Fund, and I'm buying a Kotak Emerging Equity, which are 3 Mid Cap funds. I think यार Mirai Asset, Mirai Kotak और ये Edelweiss आ गया है, तो चलो ठीक है, मैंने diversify कर लिया. Very few people have the knowledge or the willingness to kind of go inside that, understand कि अच्छा इसके ये stocks है, इसके ये stocks है, इसके ये stocks है, तो थोड़ा diversification हो रहा है कि नहीं देखूं मैं. Right? True diversification lies in category differentiation. Have a large and mid cap, small cap, flexi cap, and you're good to go, right? You've got different aspects.
Yeah, and the interesting thing is that within the same category, the difference between the top performing mid cap fund and the worst performing mid cap fund, the difference will be almost like 20-25% in a year.
Right.
Even if you see the 3-year CAGR, the difference can be a good 15% between the top performing and the worst performing. So,
chasing returns, which is also one big factor which we see in youngsters nowadays who want to kind of start up their SIP or mutual fund portfolio. कि यार ये 1 साल की रिटर्न इसकी बढ़िया लग रही है, इसमें कर लेता हूँ. Not knowing that 5 साल 10 साल की रिटर्न is very nominal and they're not even beating the benchmarks.
बहुत लोग मुझे ये आर्टिकल्स भेजते हैं कि none of our funds are in the why are they not in this rank? Like boss, you have to understand that again this is a very important stat. Any fund that is in the top quartile means top 25% of performing, right, in the last 1 year, 2 years, the chances of them remaining in the top quartile are actually less than 15% in the next year.
Correct.
So it's almost as if agar aap instead of purchasing the best fund in the last 1 year, if you actually choose from the worst performing funds, you're probably going to be doing better than picking the fund that has done well. So people don't understand that chasing returns. See, you are not putting you're putting your money in now. What's happened in the past is it doesn't matter. आपको तो अब से मतलब है ना. And since we can't predict the future, there has to be a much better method of selecting funds, right, where we can increase the probability of picking a good fund in the future rather than just looking at the past returns. In 10 years, they've got a CAGR of 7%, जबकि Nifty itself has given 15%.
Absolutely.
So that is the story that people are going through with mutual funds, unfortunately. फिर बोलते हैं mutual funds सही नहीं है.
On the flip side, there's a thing that people do at the other extreme end, which is ignore the numbers, ignore historical performance, and just buy something based on purely a story, right? And that happens a lot with NFOs. When a new NFO comes out, a new fund is being launched, they have the best marketing. And they say that this story, whether it's this particular sector is going to do really well, business cycle funds, energy sector, whatever it may be, they come out with such amazing marketing and justify that why this has to be the sector to invest in and you must invest in it. And people buy into that, not realizing that those funds, the companies that they're going to invest in, already exist in the market.
Correct.
So our existing flexi cap fund, for example, may already be invested in it. You may already be getting exposure to that. More importantly, the flexi cap fund manager can increase his allocation to that sector when it's doing well and decrease it when it's not doing well, right? So with the NFO, you're just putting your money into something and you're stuck in that. They're expensive, they don't have a track record, and it's pure marketing. So it doesn't really make sense when you're getting everything, all the positives from the NFO in your existing funds anyway, without any of the negatives.
Let's say, for example, BlueFort right now, in the last 5 years that we have been managing assets, right? Currently, we manage 500 crores worth of assets. We have a 5 to 6 crore SIP book on a monthly level, right? All we have done is 8 to 10 funds since inception.
Yeah.
And I can say this, 90% of our clients have a CAGR of about 20%, right? And that is purely due to the fact that we have avoided things we have done things what should not be done. Right, more than things what should be done, correct?
Yeah.
So no NFOs from our side at all, purely because of the fact that NFO is nothing but a marketing game.
You know how much was collected in NFOs last year?
How much?
66,000 crores alone was collected.
Because it has happened now. What has happened is अभी वो मोदी जी आते हैं बजट में बोल देते हैं या निर्मला जी बोलती है कि इसमें इसको एनर्जी को बढ़ावा दो, इंफ्रास्ट्रक्चर को बढ़ावा दो, इसके लिए इतना बजट है, तो दे कम अप विद अ लॉजिस्टिक्स फंड और एन एनर्जी फंड और एन इंफ्रास्ट्रक्चर फंड.
Now very easy for funds to just piggyback on that and just raise funds.
Correct, exactly, and that is what happens in the industry. So nothing against mutual funds. Of course, they have their own rationale and basis to do that.
Yeah, you can't
but
blame
as an
them. They're also
investor,
running a business.
it's your job to understand what you are doing. If you are doing a PSU fund, thinking there is a PSU rally coming in, if you take an SBI PSU fund which has 22% allocation to SBI as a stock, so your returns are not going to be dependent on the 30-40 PSUs there.
Right.
It is going to be dependent on what SBI does in the next 3 years. So might as well do something else about it.
People seem to think that they are much smarter. Sorry, I'm saying this, but than they are, right?
Yeah.
They feel that मैंने budget देखा है, मुझे इन्फॉर्मेशन मालूम पड़ी है, right? And उसके basis पे now I will invest.
Correct.
Like boss, everybody seen the budget. Everybody has information. If you have some information that everybody has, please assume that you will not make profit from it for sure. So
Exactly.
if they come by the time she comes on the show on TV and says that we're gonna increase our infrastructure budget to so and so much, the infrastructure stocks have probably already
उसकी rally October में आ गई है.
हाँ, उसकी rally already October में आ गई है.
Correct.
There are enough people, there are enough large players who know what's going to happen. So now you're going to buy into it. Again, same thing is going to happen. You're going to buy into it and get disappointed. मुझे बात बताओ कि PSU index has doubled in the last 1 year, for example. कितने लोग ऐसे हैं इंक्लूडिंग फंड मैनेजर्स हु हैव बीन एबल टू टाइम दिस करेक्टली कि ठीक 1 साल पहले ही उन्होंने खरीदा? नोबडी. ऑल द पीपल हु हैव शोन ऑफ सेइंग दैट ये देखो मैंने पीएसयू में इन्वेस्ट किया, हमें पता है कि वो 3-3 4-4 साल से लेके बैठे हैं बेचारे, राइट? एंड दे हैव नॉट मेड एनी रिटर्न्स फॉर सो लॉन्ग.
Another thing that we get a lot about mutual funds, and it's the question being, right, ki what are the mistakes you can make? One of the thing is the direct versus passive debate that we get sometimes.
Direct versus regular.
Direct versus regular debate that we get sometimes. Sorry. So, what is your opinion on that?
See, I think that cost is an important element, okay, of investing. But cost viewed in isolation is a very, very stupid way to invest. You should take 3 things into account. One is return, risk, and cost. And it's like a triangle where you have to consider everything. You should never pick one, stat in isolation and invest on that basis. And this has also happened because of the new age investing apps. जो asset class आपको 10% का नुकसान भी करा सकता है या 30% का रिटर्न भी दे सकता है, इतना उसमें एक टके के लिए क्या सोच रहे हो आप?
Correct.
Why think about, okay, let me save this 0.5% when the alpha can be so huge in an asset class like that? If I was investing in a debt mutual fund or an FD where I was getting a 30% extra return, 30 paisa ka bhi extra return, and the product is exactly the same, sure,
it's fair to do that.
Yeah,
right.
it was fair, but they're both giving me 7%. But why would I focus only on cost in a product that can give me either a massive return or just ruin my wealth completely?
In fact, we've had so many conversations with clients who have gave us their direct portfolio and say that you manage this now because it's not possible, and they've seen an additional return over there.
Correct.
Purely because of the fact that think of a mutual fund industry as a manufacturing setup where they're manufacturing these funds.
Right.
So the expense ratios will be high for a product that is not push, right? So for all these NFOs and something which requires effort from the distributor, right? That will, your expense ratio will be higher, and they will of course compensate you more from that.
Correct.
Now funds which are tried and tested, like your Parag Parikh Flexi Cap, beautiful fund, right? In general, your Kotak Emerging Equity, great fund, right? HDFC funds. Now these funds have, you don't need a distributor to kind of market that for you, right? These are your pull products. So then why will they give us commission that much, right? People don't realize that the simplest things, right, have no commission, very less commission attached to them, and that is something that should be done.
If someone can do a 1 lakh SIP, right, but they're only doing 30,000, okay, they're doing it in direct, they're getting that extra 1%, but it doesn't matter. It's still going to be a significantly smaller number where you can reach in 10 years versus what you did if you did 1 lakh in regular. So getting the amount right, making sure you don't stop your SIPs in fear of the war and things like that, making sure you're not chasing returns and building a portfolio of too many funds, things like that make a big difference. And just saving that 1% is not really going to make a huge impact.
Always remember, this is a very, very key metric in selecting the right fund. The SIP book compared to the AUM of the fund is a very, very important thing for a fund manager who is a very smart fund manager, but the environment of the market is such that his strategy is not working, right? But eventually that strategy will work, right? For him to execute that strategy, they need constant flows.
Correct.
Right? No fund manager can execute a strategy if there's constant redemptions coming from the fund, right?
Right.
So the fact that having a big SIP book, right? If the fund size is 10,000 crores, but 500 crore ki SIP book hai usme, the fund manager will easily be able to scale up and execute the strategy in the right way and bring his investors out of the mess that they're in, versus another fund manager, right, where he's been lucky, where they've been doing well, but wahan pe inflows nahi hai.
Correct.
So this is one example of a metric that is so important, but people don't even think about it at all.
True.
Yeah, so just to summarize what we discussed, the top few mistakes that people make in mutual funds is first buying into too many funds. having 20-30 funds in the portfolio, buying into too many NFOs, subscribing to the sales pitch that people come and give to you. It's not required. Buying into too many thematic funds, trying to get the sector right, trying to buy into the right opportunity. Again, that is not possible. Focusing too much on expense ratios and cost only. Again, not a great strategy to invest in. And investing on the basis of past returns, again, that is a failing strategy, right? There's a big difference between a good and a bad mutual fund portfolio. There's 5,000 listed stocks in India, but there's also thousands of mutual fund schemes in India, right? So your selection is everything, right? That is going to define how your experience will be in mutual funds. So don't let this amazing product give you a bad experience. Thanks so much for watching. Please do subscribe and like, and also share if you like our content. Viraj and Sayyam and myself, Siddhant, thanks a lot for watching.